So imagine selling a property for millions without paying a single cent in capital gains tax, while also being able to contribute to charity and giving yourself a lifetime income. Sounds impossible. Well, that's not true. If you know how to use a Charitable Remainder Trust, or a CRT. So in this video, I'm going to be breaking down how to use a CRT in your life and in your business, and how step by step that can save you thousands and possibly even millions on taxable gains in your lifetime. So you've probably felt it before. You've bought an asset and you've built up significant capital gains, and the asset has appreciated a ton, whether it be stocks or a rental property, and you're all excited about that until it comes time to sell and the IRS shows up. As soon as you go to sell the asset, the capital gains tax takes a huge chunk of all of your money that you've earned away from you, and it just feels like it's slipping away from your hands. And let's be honest, most people don't realize that there's ways for you to legally avoid paying taxes up front, and that's what I want to clear up for you today. I've helped dozens and dozens of clients implement advanced tax strategies just like this to save them thousands upon thousands of taxes. One of the things I love about this strategy is you're doing it all while ensuring that you leave a legacy you're proud of behind you. And today, I'm going to break it down in plain English, simple to understand, no crazy tax jargon. So, I got my coffee ready, let's get to it. So think of a CRT like this. You donate an asset, so a stock portfolio, a real estate asset, or any other appreciated asset into a special trust. This trust can sell the asset immediately while owing no capital gains tax up front. And the proceeds from that sale of the appreciated asset are then reinvested into other wealth growing vehicles. Let's say you bought $50,000 worth of a certain stock 10 years ago, and today that same amount of stock is worth $500,000. When you put it in a CRT trust, you're allowed to sell the asset and you don't pay capital gains tax on that sale. If you were to sell the asset regularly, you would owe roughly around $100,000 in taxes. But with a CRT, you can sell that stock and you keep every penny. So here's where it starts to get interesting. A CRT provides you lifetime income. After the sale, the CRT pays you a lifetime income stream. This is not a loan, this is not a gamble, it's just simply a supplemental income based on your life expectancy and your age. So think of it like planting a tree. You plant the seed and it grows, and then afterwards, every year, that tree bears fruit. So in this case, you're handing the seed, which is the asset, to the CRT, and every year it's going to be paying you out a certain amount of income in a structured way. And here's the kicker. You can also structure it to increase over your lifetime, increase the amount of income per year with different types of CRT trust. But we'll get to that in another video. Another positive about using a CRT and why it's such an advanced tax strategy is you get a tax deduction based on the value of the asset that you contributed. Now it's important to note that you'll have to subtract out the amount of projected lifetime payouts that you will get from the CRT. So in other words, you would take the amount of value of the asset donated minus your projected lifetime payouts, and that would be your charitable deduction. For example, if your CRT is projected to pay you out $300,000 and the asset that you donated was $500,000, the IRS allows you to take a deduction on the $200,000 difference between the asset and the payouts. Another cool part about CRTs is that you don't lose control over the investment asset. This is huge because it allows you to control what the new assets are being invested in within the CRT, but you're also protected from creditors, and it allows you to choose how your trust is going to grow. So think of this like giving the money to a financial co-pilot. So they're steering the plane, but you get to choose the destination and how you get there. And finally, one of the most amazing parts about a charitable remainder trust is that at the end of your lifetime, or after 20 years, all of the money, all of the assets that have grown within this trust go to a charity of your choice that you care about. That's where the R in Charitable Remainder Trust comes from, because you're getting to donate the remainder of the trust to something that you care about and support a cause that you're passionate about. So for example, take John, who has a charitable remainder trust set up with real estate assets that have appreciated up to $1.2 million. They lived comfortably for 15 years, and now at the end of their life, they're going to be donating the value of those assets. So what John can do is he can choose where he donates this. So say he has a favorite children's hospital local to him, he can donate all of the value of those assets to that hospital completely tax-free. So now let's kind of recap the steps for implementing a charitable remainder trust into your life. So first, you're going to create a CRT in advance, followed by you're going to donate assets to the charitable remainder trust. From there, the assets will be valued annually, while you also receive a quarterly or annual lifetime income from this trust. And then at the end of the steps, the charity will receive the assets at the end of your lifetime. So a couple small tips that I want you to be aware of is that charitable remainder trusts work best with highly appreciated assets. So if you have an asset that is appreciated in value significantly that you would have to pay a lot of taxes on, this is a perfect route for you to go. The second thing is that timing matters. If you can time the formation of your CRT with the year that you're going to owe a significant amount of capital gains tax, then this is a great strategy for reducing that taxable income. And additionally, you can look into advanced trust such as the NIM-CRT or the FLIP trust that can delay the distributions and even further delay some of the tax growth. So here's the bottom line. Charitable remainder trusts are an incredible way to reduce your taxable income while creating a lifelong income source and also leaving a lasting legacy that you'll be proud of. And the best part about this is that you can start with just one asset. You don't have to have a whole portfolio of assets in order to create a charitable remainder trust. So if you're nervous about paying a lot of capital gains tax or want to explore estate planning, then this is a great route for you to start considering. So if you want help setting one of these up or need help with other tax strategies within your business and your life, then click the link down in the description and you can schedule a call with me where I'll give you personally tailored advice about where I believe that we could help you and where I believe that we could work together to create your ultimate tax situation. As always, never stop your relentless pursuit of continuous improvement.